Now I understood a bit about what is about that picture there. Come on, this one, this one. So if you debit, it's written statement of financial position, but actually it refers to assets, liability, or capital. If you debit assets, liability, or capital, and credit still assets or liability or capital, then impact on net profit will not be affected at all. Impact on net assets will not be affected. Because when liability change, also assets change. When capital change, also assets change. Only if, yeah, so this is, because assets equals liability plus capital. Here, it's debited income, so, or expense. Income, it means sales, revenue. So income or expense change, debit, and credit, income or expense change. Again, profit is not affected because if you have revenue increases, so debit. Then when debit, when revenue decreases, and then expenses increases in the same way, in the same measure, in the same quantity, and then impact on net profit is not affected. And the impact on assets, the accounting formula remains unaffected, it's not affected. Assets equals liabilities plus equity. Income and expense do not belong neither to assets, neither to liabilities, neither to equity. They are just an instrument, a tool for, so it's a, they are the way the money moves. Of course, in the way, uh, base it on the way the money moves. We can have more assets or less assets, more liability or less liability, more equity, less equity. But actually, income and expense, they change. They can change. They can change the bank account. No, so the bank account is an asset, but it's not affected. The bank account, so the asset is not affected because when you have a correction that affects income, you will have the opposite also to debit, and you have to credit the expense in the same with the same value or value. And here, statement of profit or loss is debit. That it means income or expense is debited, and assets, liability, or capital is credited. Then impact on net profit decrease, impact on assets decrease. If income and or expenses is on the debit side. If, if income or expense is it's when we make the correction, it's credited income or expense, then profit will increase because income, if increases income, then profit will increase. Impact on net assets increase as well because when profit increase, also cash, the bank account increase, so then we have assets increasing. I understood something, I don't know how much it helps. Example 5. When we make the correction with debit or assets or liability or capital, that it means statement of financial position, because these three belongs to this, to the balance sheet. And credit income or expense, then what was said, the profit will increase and assets will increase. Yeah. According with that picture here. This picture. If you don't understand it, ask me, because I explained it to you. Me, I understood now. Something, not everything. Recording a missing expense. Electricity expense of 300 was forgotten. Then we debit the electricity expense and credit accrued expenses. But why we credit it? Let's ask ChatGPT why. ChatGPT is smart, and we are lucky to have it. Accrued expense means we didn't, that we have an expense but we didn't pay it yet. We didn't, and then it's a liability because you must pay it in the future. This is one of those accounting ideas that feels backward until you connect it to accrual accounting. I have to translate this. Now, what is it? Aceasta este una dintre acele idei contabile care par înapoiate până când o conectezi la contabilitatea de angajamente. Adică că urmează să plătești angajamente cu să plătești ceva. Ok, sorry for my opinion. The key idea, you credit accrued expenses because you're recognizing a liability. Something you owe, so you must pay, but haven't paid yet. In your example, you forgot to record £300 electricity expense at the end of the period. You used the electricity, so it's an expense. But you haven't paid yet, so it's a liability. The correction entry is debit electricity expense and credit accrued expense. Why credit accrued expense? Because accrued expense equals liability account. This is a good question. What happens later? So you debit electricity expense and credit accrued expense. But what happens later? You debit accrued expense and credit cash. Now because you pay, yeah, credit cash when you pay. Cash goes down and is credited because cash it's an asset. If no cash has left yet, but you recognize an expense, ask, who do I owe? That's your credit liability. That's your credit liability. So expense and accrued expense, credit. Which usually makes it click instantly. Okay. Because we didn't record it. Profit too high because we didn't record it, the expense. Balance sheet. accounting formula is so accounting equation is assets equals liabilities plus equity, and we can have no change of assets if liabilities change, increases, but equity decreases. When we have debit income, or so statement of profit and loss, income or expenses, and credit income or expenses. Here we have expenses, and accrued expenses is liability actually. Then it's affected. It's affected here in this case. It's affected. We have the statement of profit and loss expenses, and we have the statement of financial position credited. And in this case, the picture says that not here. Here I have to go around. Yeah, finally. So they say if as expected is debit, where in this case, third one, then profit decrease, assets decrease, because we have liability credited as accrued expenses. And